All right, let's get right into it. Today, we're cracking open the economic engine of private equity. Forget the high-level stuff you'd get in a basic textbook. We're going on a full 10-year journey inside a PE fund. And by the time we're done, you're going to understand the deep mechanics that have built one of the most powerful and, let's be honest, most misunderstood asset classes in all of finance. To really get what private equity is today, you have to wrap your head around its insane scale. This quote from an industry veteran, it's not just about the numbers, it captures a huge seismic shift. What used to be this tiny, almost invisible corner of the market has just exploded into a dominant force in the global economy. And here's the chart that shows you exactly what he means. Look at this. In 1980, the entire US buyout market raised about $180 million, barely a blip. But just 7 years later, that number shot up to almost $14 billion. That's not just growth, that's a total paradigm shift. It's the moment private equity really arrived as a major institutional asset class. So, how does this whole thing actually work if you're an investor? This is where we run into this central problem, the real dilemma. As an investor, and in the industry you'd be called a limited partner or LP, you are committing millions, sometimes hundreds of millions of dollars for a decade, and you're handing it over to what's basically a blind pool. You trust the fund managers, sure, but you get no say in the actual investments, and you have no idea when or even if you'll ever see a return. Let's make this totally real. Imagine you just committed $10 million. For the next few years, all you're going to get are these things called capital calls. That's the fund asking for your money to buy companies and pay their own fees. You won't see a single dollar coming back your way. For a long, long time, your investment is going to be deep in the red. Now, this journey, this predictable path from negative to positive cash flow is so fundamental to private equity that it has its own name. It's a concept that every single person in this business knows inside and out. It's called the J-curve, and it's really just a graph that tracks your cumulative net cash flow, all the money going out versus all the money coming in over that entire 10-year fund life. And you guessed it, it gets its name from its characteristic shape, which we're about to map out. So here's how the J-curve plays out in the real world. At first, it drops, and it drops pretty steeply. That's the fund calling your capital to make investments and pay fees. Then, as the fund starts to sell some of its first companies, you get cash distributions back, and that slows down the curve's descent. And finally, in the later years, as the really big, successful exits start happening, the curve swings up, climbing sharply into what you hope is very profitable territory. Okay, now really think about this from the investor's seat. Watching that number just go down, down, down for 3, 4, maybe even 5 years. That takes some serious guts. So what's the secret sauce? What's the mechanism that gives investors the confidence to stick it out, believing the fund managers are working day and night to make that curve climb as high as it can possibly go? Well, the answer is all in the compensation. It's a brilliant model designed specifically to align the interests of the fund managers, the general partners, or GPs, with you, the investor. And throughout the entire industry, it's known simply as 2 and 20. Let's break down 2 and 20. The 2 is a 2% annual management fee. It's usually charged on the total amount of money you've committed to the fund. This is what covers the firm's overhead, salaries, rent, travel, the boring stuff. But the 20 is the real driver. It's a 20% share of the fund's net profits. This is called carried interest, and it's how the partners at these firms make their fortunes. But here is the most critical part of this whole equation. If the general partner, the GP, gets 20% of the profits, that means you, the limited partner, get the other 80%. See how that works? The management fee just keeps the lights on. The carried interest, though, that creates this massive incentive for the PE firm to generate huge returns. Their biggest payday only happens after you've gotten all your money back, plus a whole lot more. But it's not quite as simple as just splitting the profits 80-20 at the very end. No, there's a very specific, very strict order for how cash from a successful exit gets paid out. And this sequence is called the distribution waterfall. Think of it like a series of buckets that have to be filled up in order. First, 100% of any cash coming back goes straight to the LPs until every dime they invested is returned. That's bucket number 1. Step 2, the LPs keep getting all the cash until they've earned a minimum return, which is usually around 8% a year. That's the preferred return. Only after that happens in step 3 does the GP get to catch up by taking profits until they've received 20% of the total profit so far. And then finally, all the cash after that is split 80-20. Now, here's a pro tip, something you won't always see in the standard textbooks. This waterfall structure, it's not the same everywhere. With the European model, which is more conservative, the GP doesn't see a penny of carried interest until the LPs have gotten back all of their invested capital from the entire fund. The American model, on the other hand, is deal by deal. That means a GP can earn carry from a big win early on. Now, that's riskier for investors, right? Which is why these agreements always have clawback provisions, forcing the GP to give that money back if later deals end up losing money. So all these sophisticated structures, the J-curve, the 2 and 20, the waterfall, they didn't just appear out of nowhere. They're the product of decades of evolution, of trial and error, that took what was basically a cottage industry and turned it into a global financial machine. You know, back in the 70s, this was almost entirely a small US-based venture capital game. Then, in the early 80s, you had pioneering firms like KKR basically invent the leverage buyout. The market went wild, building up to the legendary RJR Nabisco Barbarians at the Gate deal in 1989. That deal was so big it shook Wall Street to its core and ushered in a whole new era of corporate takeovers. After that crazy peak, the industry kind of grew up, rationalized, and went global through the 90s and 2000s to become the powerhouse that it is today. But for all this talk about complex financial engineering, spreadsheets, and legal structures, it is so important to remember this. At its heart, private equity isn't just about the numbers. It is, and it has always been, a business built on people, on relationships, on trust, and on finding and backing the right management teams. Okay, we have covered a ton of ground on this journey. So let's boil it all down into the 3 absolute essential economic principles that you need to walk away with. First, the J-curve. It means investing in private equity requires patience. You have to be comfortable with years of negative cash flows before the big profits show up. Second, the 2 and 20 model. It's all about aligning interests, making sure the managers are laser-focused on generating profits. And third, the waterfall. It is a critical investor protection that creates a strict LP's first rule for getting paid. So this model has proven to be incredibly effective at transforming businesses and generating massive returns. But as the industry gets bigger and bigger, stretching into every corner of the global economy, the final question we're left with is, what's next? What will be the next big evolution in how we finance and partner with companies to define the future of this incredibly powerful asset class?